Okay, students. So up to now, we have done two types of derivatives. Forwards we have done and options. Next, we will look at swaps. Okay. So swaps are interesting. They are over-the-counter instruments, right? Which are used for risk management by many banks, companies, yes, importers, exporters, etc. Yes. So basically, it is an instrument where you agree to exchange cash flows. One person is interested in fixed rate interest rates, the other one is interested in floating rates, they can do a swap. One person is interested in fixed income returns, another person is interested in equity, risky returns, they can do a swap. One person is interested in one commodity, another person is interested in another commodity, they can do a swap. So again, importers and exporters in different currencies can do swaps. So basically, you can have these type of swaps in practice, and swaps can be executed in any of these different cash flow exchanges. Okay. So please note, since swap is a derivative, the cash flows exchanged are based on a notional amount. What is a notional amount? Notional is the swap is actually exchanging cash flows, but it is not exchanging entire cash flows. However, the cash flows exchange, just like an option or a future, controls a large amount of the underlying asset. Swaps exchange large amount of cash flows. Okay, technically, the exchange in a swap controls larger cash, though the actual notional amount is not exchanged. Okay, so notional is an amount, large amount, covered in the exchange of the cash flows in the underlying swap. Though it is not, though the entire notional amount is often not exchanged. Okay, but that's something that you have to do, and the parties in engaging in swaps are counterparties. So there is something called bid ask and pay receive spread. Anybody who wants to sell will so this, when people execute a swap, one of them will execute it at the bid ask spread and the other one will do the pay receive spread. So so essentially these dealers, when they execute a swap, will execute it as counterparties. Okay, so there are many types of swaps. We will look at a few swaps right now. So we will look in detail into two types: interest rates and the currency swap. We will glance at a few other types of swaps as well. So the first and the most widely used swap, which serves as the basis for all swaps, is the plain vanilla swap. Okay, so I'll show you a figure. So some terminology: effective date when the swap starts, termination date is your ending date. So the time between the two is the tenor. So this is how it is. So there's a dealer who brings two parties together. One party pays one set of cash flows, the other party receives and sends another set of cash flows. So basically, two sets of different cash flows are exchanged. The swap dealer is somewhere sitting in between and taking a small commission for bringing the parties together. Is that clear, students? Have a look at that diagram. We'll be doing some numerical, I'll be going through some numerical examples. At that point, you will understand. So the point in doing a swap is what? If two people are doing a swap on interest rates, why would they do a swap? Basically, the goal is to lower each party's borrowing cost. So if I am borrowing at 5% and somebody else is borrowing at 6%, and if we do a swap, the goal is to reduce our borrowing cost. Okay, so let's see how that comes about. Okay, so one of the most widely used applications of swaps are in the interest rate arena. Okay, give me just a minute. I'll come back and explain this to you. Just need to get. So interest rate swaps are the most widely used application of swaps. I'll just come back and we'll get into a discussion on that. Okay, students. So now let us look at an exchange of cash flows, fixed and variable cash flows, right? So have a look at this. So Microsoft is going to take in, is doing the swap. What are they trying to do here? They're basically borrowing, want to receive 6-month LIBOR. Any of you heard of LIBOR? You would have, right, students?
Yes.
What is that?
It's like a fixed interest rates in Europe.
So it's actually a variable interest rate benchmark.
Yeah.
So LIBOR stands for London Interbank Offer Rate. The equivalent of that in India is what? MIBOR. So this is a variable rate benchmark. So all variable loans are usually priced as a function of LIBOR. So Microsoft, in this example, what are they going to do? They're going to receive LIBOR, meaning they're going to receive floating rates and they're going to pay fixed rates. Yes. So they're going to receive floating rate and they're going to pay fixed rate. So when would you do the swap, this type of swap? So if you're paying a fixed rate and you're receiving a variable rate, what do you think is going to happen now? When will I do this type of swap? Students, take a guess. Guessing is allowed, right? So I'll kind of do the swap if I think interest rates are going up, right?
Yes.
Yeah. Yeah. So if I'm receiving variable rate and I'm paying a fixed rate, I'm very sure that interest rates are going up. So in that event, I will do this. Now, if I think interest rates are going down, I would do the other way around, right? I would receive fixed and pay floating.
It's
Yes?
similar to hedging.
Yeah, basically here you are hedging interest rate risk. Exactly correct. You are basically hedging interest rate risk. Very correct. There you go. So, so have a look at this. Slide is a little zombie-ish because formatting has gotten out of hand, but you can see how this works. Yes. So once interest rates start going up, yes, Microsoft is actually into positive cash flow. So when are they going to get positive cash flow? Right now, the interest rate is 4.2. They're making negative cash flow because the fixed, this is 6 months. So we are halving the rates. Yes, halving the rates on both floating and fixed. So once interest rates cross that 2.5 mark and keep going up, Microsoft is starting to make positive cash flow. So as expected, the interest rates go up and you make positive cash flow. So this is the benefit of a swap. So you're basically hedging against interest rate risk, but you have to be correct on the direction of interest rates. If you think interest rates go up and it goes down, then you'll lose, right? So you should know the situation. So right now, what are we going to do? Will we do this or the other way around? So right now for the next 6 months, this type of a swap will work because interest rates may still continue to go up. But I think in about 6 months time, once recession is in, then the reverse, interest rates may start going down and you may want to look at the reverse situation. Is that clear, students?
Yes, sir.
Any questions? Okay, now let's look at some uses of an interest rate swap. So you can convert a liability or payment you own from a fixed rate to a floating rate or floating rate to fixed rate. You can convert an investment or an asset you have to from a fixed rate cash flow to a floating rate cash flow or vice versa. Yes. So for both, you can use an interest rate. Have a look at this, students. Okay, students, so there is the swap is often done diagonally. Okay, so one will borrow in fixed and the other is floating. Okay, so now you've been given the situation. So if A were to borrow what, so the idea is what? When we do an interest rate swap, I was alluding to this. What is the idea behind doing an interest rate swap?
To get protection from higher rates.
So that is one thing. The other part is to lower your interest rates, right? To lower
Yes.
your cost of borrowing. So in this case, have a look. So A is going to borrow fixed and B borrows floating. So what would A try to lower its rate? So A's fixed rate borrowing is 10. So diagonally B's floating rate borrowing is 6-month LIBOR plus 1.6. So A is going to try to lower its 10% rate and B is trying to lower its 6-month LIBOR plus 1.6 rate. Is that clear? Because it is given in the sum. A borrows fixed, B borrows floating. Is that clear? Yeah. So those are the rates we try to lower now. So how do we do the swap? So first of all, we should, let us assume A and B are directly doing the swap and there is no intermediary or a banker, which is unusual. So basically our potential gain to be had or margin available is your difference in floating rates minus difference in fixed rates minus difference in floating rates. So I have left out the LIBOR for easy cancellation purpose. But if you do that, the potential gain is 12 minus 10 minus LIBOR plus 1.6 minus LIBOR plus 0.4. So if you do that, you'll get a margin of 0.8. Are you understanding, students, how this number comes 0.8? Yes, no?
Yes.
Okay. So this 0.8 is divided equally among the companies. So if you do that, you'll get 0.4 and the A's rate will now come down 10 minus 0.4, which is 9.6. B's rate will now come down LIBOR plus 1.6 minus 0. Because of their ability to do this swap together. So both have lowered their rates. Is that clear?
Yes.
So that is the goal of doing an interest rate swap. Now, normally this is not perfectly possible. Usually a banker will come in between. In that case, the 0.8 is divided equally between company A, company B, and a small commission is given to the broker in between. So we can say, but only a small commission for the broker. Majority of the money is still given equally divided by, majority of the margin is still equally divided between company A and company B. Okay. So how can we divide 0.8 among 3 people, giving most to point A and B? How do we do that? Any idea? So we can give 0.3 to company A, 0.3 to company B, and 0.2 to an intermediary. Or 0.1 to an intermediary and 0.35 to company A and company B. Yeah. So that's, so this is how the swap will look when there is a banker in between. So banker will take a commission, usually a small amount. The rest will be equally divided among company A and company B. So if you do that, what will happen? We will lower it by 0.3. So this rate, okay, so same rate will go. A's rate will now come to 0.10 minus 0.3, 9.7. B's rate will be 6-month LIBOR plus 1.6 minus 0.3. So 6 months LIBOR plus 1.3 and the broker will take 0.2. Is that clear?
Yes, sir.
Yeah. Any questions, students? Now, what happens if the swap is the other way? B borrowing in fixed and A borrowing in floating. So in this case, B will try to reduce its 12% rate and A will reduce its 6-month LIBOR plus 0.4. A will try to reduce that. If it is the other way around, if B were to borrow in fixed and A were to borrow in floating. Is that understandable? Yes?
Yes.
So you have to just first read the sum and figure out who's borrowing in fixed and who's borrowing in floating. Okay, now let me look and see. If I have a good swap video here.
Through my online store alone, we've sold
In this video, we're going to take a look at a way that companies can reduce their borrowing costs. It's quite a clever way. It's called a swap. Sadly, it's not something that's directly available to retail investors because the amounts involved are fairly large. But it is an important part of how banks go about determining what, for example, you pay on your mortgage, whether that's a fixed or variable rate, and also what you ultimately get charged for loans. So the swaps market is huge and it underpins an awful lot of what goes on day to day when it comes to your basic financial needs and products. So what we'll do is take a quick look at a swap, how it works, how banks make money from it, and also one or two of the applications. And we're going to focus on interest rate swaps. Interest rates are thought to be on the way up. The Bank of England may raise rates this year. The only question is when. So in financial markets, companies and banks will be running around wondering how to hedge an exposure to what could be rising interest rates after a period of relatively low rates. Okay, so what is a basic swap? Well, imagine you've got a company, and for the sake of argument, I'll just call them Company A. And just to demonstrate how a swaps bank makes money, I'll have two clients in my example. So Company A and Company B. And a bit like you or I, they need to borrow money in order to expand. They need 5 million each, just like you might apply for a mortgage, and they have different views about interest rates. So Company A would like, ideally, to borrow at a variable rate of interest. Perhaps they feel that interest rates are on the way down, or Company B would like to pay a fixed rate of interest, and that's a bit like the mortgage market. Some people like a fixed rate of interest over, say, 5 years. Some people are happy to take a variable rate of interest over the same term, and banks have to cater to both types of mortgagee. So remember that Company A's aim is to pay variable interest on the money it borrows, and it's going to borrow 5 million. Company B would like to pay fixed interest on the money it borrows, and it's also going to borrow 5 million, and these two companies don't actually know each other, and we'll see how a swaps bank can improve both their lives, how a swap can help. Okay, so Company A goes to its bank, which rather unimaginatively I'll call Bank A. Company B goes to its bank, which I'll call Bank B. Basically, here are the terms on offer. Now, Company A is big, well-known, well-established. Company B, a little bit smaller, finds it harder to raise money. So, Company A goes to its bank and is offered the following. The bank says, if you want to borrow 5 million from us and pay a fixed rate of interest, you'll pay us 7%. If, on the other hand, you'd like a £5 million loan at a variable rate of interest, you can pay us the London Interbank offer rate, LIBOR. Now, that's a variable rate set by the banks between themselves that fixes the variable cost of borrowing for companies that want to pay variable rates of interest. So LIBOR changes. Potentially, it can change every day. Around mid-morning, the banks get together and decide what the London Interbank offer rate is going to be, and that's then published by the British Bankers Association. But the important thing with this example is it's a variable rate. So the fixed rate of 7 won't change over, say, 5 years. LIBOR might, depending on what happens to the Bank of England base rate. Okay, Company B goes to its bank. Now, Company B is less well known. That's life. It's smaller. It doesn't have the clout of Company A over here. So the bank says, well, if you want a fixed rate, you'll pay us 10%. And if you want a variable rate, you'll pay us LIBOR plus 1. So whatever LIBOR is, you're paying us 1% or 100 basis points over LIBOR. So if in 3 years' time, LIBOR's 8%, you're paying us 9. If in 5 years' time, LIBOR's 10%, you're paying us 11, and so on. Or you can just take a fixed rate, so when you get out of bed in the morning, you know exactly what you're paying, but that's 10%, take it or leave it. Okay, now, you might think Company B wants a fixed interest loan, so it just takes the 10%. Company A wants a variable rate loan, so it just agrees to pay LIBOR on 5 million. But actually, and you may be able to see what's coming, there's a way for a swaps bank, which I'll pop in here, to help both of its clients and make a bit of money for itself at the same time. And here's what's going to happen. Despite wanting to pay a variable rate, let's assume, and this is a slightly artificial conversation, but it'll get us through the example and show how the whole swap can help everybody. Let's assume the conversation goes like this. The swaps bank says to Company A, I know you'd like to borrow 5 million at a variable rate. But actually, when you take out a loan with Bank A, what I'd like you to do is the exact opposite. So, by all means, take a loan from Bank A for 5 million, but pay Bank A the fixed rate of 7%. Then it goes to its other client, Company B, and says, I know you want to borrow at the lowest possible fixed rate, 5 million, but bear with me, go to your bank and take out a loan at the variable rate. So in other words, go and get the money you need from Bank B, £5 million once more, but pay them the variable rate of LIBOR plus 1. So what you have so far is two companies. They've taken out separate loans, both for 5 million, with their own banks, and at the wrong rate in both cases. So, how can a swaps bank give them the rate they want and reduce the cost of it? Here's the answer. Okay, now I'm going to make up a few numbers here. These don't have to be the exact numbers, but let's say, for example, and here come the two swaps. Why two? because it shows how the bank can make some money and also help two clients. And it also shows how the bank can sort of offset risk on each side. So let's say the swaps bank says, right, I'm going to do a swap, a separate deal with each of my clients, and these are separate swaps. So there's swap 1 and there's swap 2. And literally a swap is just exchanging one thing for another, in this case interest rates. So the swaps bank says, okay, company B, you've borrowed 5 million from bank B. You don't need another 5 million from us. You just want to change the interest rate you're paying on that loan. You're paying a variable rate and you'd rather pay fixed. So without borrowing another 5 million, let's agree a swap just for the interest on what's called a notional amount of 5 million. In other words, we're just going to swap the interest payments you're committed to, nothing else. We're not giving you another 5 million, because that'd be 10. You don't need another 5 million from us. You just want to change the interest payments from variable to what you originally wanted fixed. So basically here's the deal. Swaps Bank says, on a notional 5 million, we'll pay you LIBOR and you can pay us 8.5% fixed. Then it goes to company A and says, we'll do a deal with you, another swap. Basically, you pay us LIBOR and we'll give you 8% fixed. So there's swap 1 with company A, separate contract. There's swap 2. No new cash changing hands, no 5 millions, just an agreement to swap the interest payments on what's called a notional amount of 5 million. In other words, every, let's say, 6 months, the swaps bank will settle the difference with company B between LIBOR and 8.5% on 5 million. And every 6 months, it'll sit down with company A and swap the difference in interest terms between the LIBOR rate and a fixed 8% on 5 million. So that could mean, depending on what LIBOR does, which is a variable rate, company B could be paying the swaps bank or vice versa, and the same on this side. Now, looks complicated, but actually here's the bit of financial magic. Because, first of all, the swaps bank is making money. It receives 8.5% from company B and pays 8 to company A. It pays LIBOR to company A and LIBOR to company B, both on 5 million sterling. So basically, whatever LIBOR is, 5 million times LIBOR flows in and flows out, and 8.5% on 5 million comes in and only 8% goes out. So the swaps bank is making 0.5% as its profit. And 0.5% of a big number is worth having. And it'll make that 0.5% even if the interbank variable rate was 20%, because 20 comes in, 20 goes out, so that's neutral, but it still makes the difference between 8.5% and 8%, provided company B keeps paying over the term of the swap, let's say 5, 10, 20 years, it'll make that 0.5%. Now what about its clients? Are they happy? Company B wanted to pay the lowest possible fixed rate. The bank B offered it 10%. That's as low as bank B was ever going to go. With the swap, look what's happened. Basically, LIBOR cancels. If you like, mathematically, I can do that. Because whatever LIBOR is, it comes into company B on 5 million and goes out on 5 million, leaving plus 1%. So what is company B effectively paying on its original 5 million loan from bank B through a combination of the interest agreement with bank B and the swap? And the answer is 8.5 plus 1, or 9.5% fixed. And 9.5% fixed is less than 10% fixed. Thanks for that, Tim, but that's the point. It saved itself 0.5%. You might think that's not much, but on 5 million over, say, 10 years, that's worth having. Company A, on the other hand, always wanted to borrow 5 million at the lowest possible variable rate. Its bank said, if you come to us, you'll be paying us the LIBOR rate. That's the best we can do. You'll be paying us the interbank rate. As a result of the swap, where is it now? And the answer is, paying LIBOR to the swaps bank, but receiving 8% on 5 million and only paying out 7, fixed in both cases. So given that's a fixed 1% saving on 5 million, in effect, company A is now paying LIBOR for the whole term of the loan minus 1%. And that's better than paying LIBOR. And that is the point of the swap. Ultimately, company A is now paying a variable rate of interest which is lower than it could have got from its own bank. Company B is paying a fixed rate of interest which is lower than it could have got from its own bank. And it works because of something called comparative advantage. What the swaps bank knows, because it knows both clients, is they are able to borrow at different terms, just as you and I borrow at different terms. The terms for loans and mortgages and so on can vary depending on the size of your deposit, your credit history and so on. And that's the same for companies. All the swaps bank's done is to spot the gap and make a bit of money for itself by setting up 2 swaps with its clients. Now, I've made that sound very simple. There are some risks. If company A or company B go bust, you've got a problem. So the swaps bank needs to be fairly sure that both clients are capable of meeting their obligations under the swap. It might take some security from them, that's called collateral. And you might think, how does this help me in the retail market? Well, the answer is swaps banks and swaps do help to bring down borrowing costs for everybody. So not just for companies, but on mortgages. But unfortunately, if you're thinking, well, you know what, I'm paying a variable rate mortgage right now, or I really wish I could swap that for a fixed rate as interest rates rise, sadly, your mortgage probably isn't worth enough to a swaps bank to arrange an interest rate swap. The economics just don't stack up. You'd have to cancel your mortgage and start again, if you like, and that's probably something that's prohibitively expensive. But it's worth bearing in mind that the existence of swaps is one of the reasons why mortgage rates aren't potentially higher than they otherwise would be.
Okay, students. So that's the video of a swap. So I made it a little straightforward and easy by showing you the calculation. So then it is easy for you to understand how the rates are lowered. But the point is, you do a swap to lower rates for both parties. Okay, so that's the key takeaway that you should be familiar. Any questions, students? Any questions you guys have on that?
No, sir.
Okay, so now I'll go to the next topic. Let's see. Where is my class? Oh, there you go. Now, how are these swaps valued? How do we find the value of a swap? So basically, given there is an exchange of fixed and floating rate cash flows, you can treat the swap as a combination of 2 bonds. So, and if you can find the value of these 2 bonds, the difference between the bond payment you receive and the bond payment you pay is basically the value. So if you find the present value of both the floating rate bond and the fixed rate bond and find the difference, that is how you find the value of the swap. So here is an example of that. So this is the formula for finding the value. This is just for your information. So again, so if we have a swap between fixed and floating rates, zero rates or zero coupon rates basically on the bonds. So then you can value the floating rate bond, value the fixed rate bond, and find the difference as paid minus received, or received minus paid. So you value the fixed bond, value the floating bond. Yes. Basically, you're finding the present value of principal and interest. As you recall in your fixed income securities that Kiran Bindu sir taught, he would have taught you to value bonds, right? How did you value bonds? Present value of principal and present value of interest. So you find in this case, floating minus fixed, or in this case, fixed minus floating. Received, always received minus paid. If you do that, you'll get around about 1.96. So basically, you're valuing a swap as a combination of two bonds. One bond you will receive, the other bond you will pay. The difference is the. Now, the next swap, next set of swaps which are also used is currency swaps. Okay. So in currency swaps, you are basically exchanging cash flows in different currencies. In interest rate swaps, we were discussing cash flows in different interest rates, floating, fixed, etc. In this case, we are exchanging cash flows in different currencies. So what is the big difference between currency swap and, for example, an interest rate swap, for example? So the currency swap, the entire principal is exchanged. So the notional amount here is the whole amount is exchanged. There's no notional, the whole principal is exchanged. Whereas in an interest rate amount, the notional amount is not exchanged. Okay, the entire principal is not exchanged. Only a small notional amount, the transaction do not reflect the entire amount. In an interest rate swap, the entire principal is not at all exchanged. However, in a currency swap, right, the whole principal amount is exchanged. That's the difference between currency and interest rate swap. So principal exchange happens in a currency swap. Because of that, if the principal is exchanged, then you have exchange rate risk. So from the time you executed the swap till the end of the swap, if the exchange rates change, then the principal amounts get impacted by that. So you must hedge that risk because you are exchanging principal. Is that clear, students? The difference, primary difference, you must understand. So in an interest rate swap, principal amount is not exchanged. So you don't have to worry about hedging interest rate risk. But in currency swap, the principal amount is exchanged. So if the exchange rate changes before, from the time you started the swap till the end, then you have to hedge the exchange rate risk. So just like interest rate swap, currency swaps have certain functions. You can achieve through them. You can convert a liability from one currency to another. You can convert an investment as well from one currency to So here is an example of a currency swap. One wants to borrow in USD, the other one wants to borrow in Australian dollars. You can do a swap between the two. Okay. So have a look at this. Just like there is no difference really in the calculation. Same way we find out the margin. And the idea is to reduce the borrowing cost in the different currencies. One company will borrow in one currency, the other one will borrow in another currency. Either the goal for us is the same as before. We want to reduce the borrowing costs in both currencies. Okay. So this is like taking foreign loans and local loans and seeing and doing a swap and lowering the cost of both. So have a look. So if you look, the margin is the same. So difference in the higher currency, higher borrowing cost minus difference in the lower borrowing cost. So the total margin available here will be 12 minus 10 minus 6 minus 5. So if you see, it will be 1. So we'll have to split that equally between company A, company B, and give small amount to the bank. So if we do that, bank will get 0.2, 0.4, 0.4 coming to company A. So company A is basically going to lower its rate from 5 to 5 minus 0.4, 4.6. Company B will lower its rate from 12% to 11.6. So the 0.4 margin will be given to each company and they will lower their rates by that much. Is that clear, students? Same concept as before. Yes, students?
Yes, sir.
Yeah. So valuation of a currency swap is pretty similar to valuing interest rate swap. So we can look at valuing currency swaps as also a combination of two bonds. So one bond in one currency, whereas and the other bond is in a different currency, once again received minus rate. So example. So basically we are finding present value of the bond in one currency, finding the present value of the bond in the other currency, and always receive minus rate. Okay, students. Now I'm going to play a video on the currency swap. Any questions, students, on what is being discussed? Just understand the relevance of these swaps. Yes. Basically, an interest rate swap is used to hedge interest rate risk. Currency swaps hedge currency risk. So basically, you reduce your borrowing costs in different interest rates, either floating or fixed interest rates, or if you have taken foreign loans. Either way, the goal of the swap is to bring two parties together and reduce their interest. Okay, students, any questions on the goal of swaps or anything about swaps you guys want to know further?
No, sir.
Okay. Mahesh, do you know when this class is coming to an end? What is the last date given to you?
I think 15th, August 15th.
Oh, okay, then we'll wind up all assignments. We should wind up by then. Okay, August 15th, let's keep the last date for the assignments then. So you mean to say there's just one class left after this?
Yeah, actually, I can't confirm it, but at the starting of the exam, we get an email of all the Zoom links. It has only August 15th was the last date, last link we have.
Okay, so there should be 10 classes actually, technically. So, so I think if I'm right, this is my 8th class, is that right? Anyway, we can check that later. So, okay, so let us, guys, so please ensure you submit all assignments. Only 2 have submitted. Yes, 50 marks is to be given by me. So if you have not submitted, you're not going to get any marks. So that's plain simple, right? I don't give marks for the sake of giving. You have to submit assignments to get marks. And the assignments were made very easy this time for you guys. But still only 2 have submitted. Okay, so that's that then. So let us look briefly at what an interest rate currency swap is.
Hey, click on the link below, Ale. I have a rapid fire for you. Are you ready?
Let's discuss the concept of a currency swap. Now, in a previous video, I discussed interest rate swaps, and interest rate swaps are relatively simple because in most cases you don't need to exchange the principal, it's just exchanging the cash flows, a fixed rate for floating rate. Now, this is going to be different because we're going to be dealing with 2 different currencies, and we're going to have more options in terms of the possible interest rates or cash flows that are exchanged. Now, currency swaps are most often used when companies make cross-border capital investments. So, for example, a U.S. parent company wants to finance a project undertaken by its subsidiary in France, and they're going to use the project proceeds to pay the interest and the principal. What are their options? They could borrow in the U.S. and convert that to euros, but that exposes the company to exchange rate risk. They could borrow in France, but the rate available there may not be as good as it is in the U.S. because the subsidiary is relatively unknown. The third possibility is to find a counterparty and set up a currency swap. Now, currency swaps are more complicated than single currency agreements because cash flows are denominated in different monetary units. Therefore, the principal amounts are usually exchanged at the origin and at the maturity dates of the contract. So, because 2 currencies are involved, interest rates defining the transaction can be expressed on a fixed or floating rate basis for either or both currencies. So there are 4 possible cases. You could have a fixed US rate and a fixed foreign rate. You could have a floating US rate and a fixed foreign rate. You could have a fixed US rate and a floating foreign rate. Or you could have a floating US rate and a floating foreign rate. Now, the most common is a fixed foreign rate for a floating US rate based on LIBOR. And normally, a currency swap takes place because a company has a comparative advantage borrowing locally. What does that mean? That means that they can borrow at a relatively lower rate than their counterparty can at their in their local market. So let's take a look at this picture here. So company A would issue securities in the local market. Company B would issue securities in their local market. And you can see the cash flows. Company A would pay, we're going to put a bank in between as an intermediary. Company A would pay the foreign rate to the swap bank and receive the local rate. So these are going to cancel out essentially. The company B is going to pay the foreign rate to the swap bank and receive its local rate. And so these will cancel out. So essentially company B will be getting the rate issued by company A in their local market. Company A will be getting the rate that company B gets in their local market. All right, it's a little confusing. Let's look at an actual numerical example. We have too much issue local, issue local. So consider the following example. Suppose you have a U.S. multinational corporation that wants to finance a $40 million euro expansion of a French plant. Well, they could borrow dollars in the U.S. where they're well known and exchange the dollars for euros. But as we mentioned before, this is going to give them exchange rate risk. Okay, financing a euro project with dollars means that, you know, they have to exchange the money to euros and they have to exchange them back to dollars, interest rate risk. They could borrow euros in the international market, but they might pay a premium because they're not as well known. All right, if they can find a French multinational corporation with mirror image financing needs, they may both benefit from a swap. So they find a French company that wants to borrow essentially the same amount of money but wants it in US dollars. So let's consider that the spot exchange rate is $1.30 per euro. And the US firm needs to find a French firm wanting to finance a dollar borrowing amount in the amount of $52 million. Right? 40 million euros at the $1.30 rate is $52 million. So here we have, you know, we're trying to find two firms where they match up. U.S. company wants to borrow 40 million euros. French firm wants to borrow $52 million. All right, if they're fortunate enough to find each other, let's consider we have these two firms, A and B. A is the U.S. company, and B is the French-based multinational. So company A can borrow at an 8% rate in the U.S. market and can borrow at 7% if they're borrowing in euros. Company B, if it wants to borrow in the U.S. market, pays a 9% rate, but company B pays a 6% rate when they borrow in their local markets in euros. So you can see that each one has an advantage. Actually, B has an absolute advantage in borrowing euros, and company A has an absolute advantage in borrowing dollars. All right, so let's see what happens here. Here's firm A. They borrow the $52 million in their local market where they're able to borrow at this 8% rate. Firm B is the French firm. It borrows 40 million euros at this 6% rate. Okay, so they're each borrowing where they borrow cheapest. What firm A is going to do is firm A is going to pay the swap bank a 6% rate on these euros. And the swap bank is just going to pass that along to firm B. So you can see 6% in terms of euros goes to the swap bank, and then 6% goes to firm B. Firm B, on the other hand, is paying 8% in terms of US dollars to the swap bank, and the swap bank is passing it on to firm A. So you can see that what happens here. Firm A's payment, the 8% in dollars that it borrowed, is canceled out because it's paying 8%, but it's receiving 8%. So now it's essentially paying a 6% rate on euros. Here, firm B is paying 6% to borrow these 40 million euros, but they are also receiving 6%. So that cancels this out. So firm B winds up paying an 8% dollar rate. Firm A winds up paying a 6% euro rate. All right. What are the annual cash flows? Well, 8% of this 52 million for firm B is 4.16 million. For firm A is paying 6% on the $40 million euros, so it's paying 2.4 million euros. In this example, the swap bank isn't making any money. All right, we certainly could have modified this so that the swap bank gets a cut, which certainly they would. All right, so what's our net position here? A is borrowing at this 6% euro rate. B is borrowing at the 8% dollar rate, right? And here you can see that had company B gone to the US market and borrowed in dollars, they would have paid 9%. They're saving 1%. Here, if A had borrowed in France in euros, they would have paid 7%. So each company is 1% better off. So this swap allows both of the firms to benefit from borrowing where they have an advantage and swapping with a firm that borrows where they have an advantage. So in this case, the U.S. firm borrows in the U.S. and borrows in dollars. Firm B borrows in France and borrows euros, and they exchange the cash flows, and both of the firms are better off. So this is a relatively simple example of a currency swap, but it shows you that there can be real advantages to firms by using this rather than just going out and buying foreign currency.
Okay, students. So one of the primary goals of a swap is to do what, students?
Reduce interest rate.
Correct. So reducing companies' borrowing costs. So that is the reason why we do swap. So basically you are lowering your borrowing cost. Now, another aim of swaps is to reduce. See, sometimes you may have a big bond portfolio, but some bonds in your portfolio may be issued by companies with lower credit. And there is a chance if a recession comes that these companies may default. So how can I assess my default probabilities? So can I protect myself using a swap against default? The answer is you can. There is a swap called the credit default swap. Okay. So credit default swap, basically you are exchanging, you are paying a premium, a fixed payment in exchange for default protection. Yes, so you have bonds of a portfolio of a company, you think it's going to default. What do? You buy a credit default swap on the bond. So in case the bond defaults, you are actually paying a premium every 6 months or so for credit default protection. So in the case default happens, you get the full principal of your amount back by the company that issued you default protection. Okay, so default in general is a risk that happens. Every now and then you had companies like Kingfisher default. Yes. So default probabilities can be gauged by number of models. There is a Altman bankruptcy model, there's a Bayesian model, there's a Merton model, which looks at default from stock prices. But how do you actually gauge default probability? By looking at credit spreads. You can actually gauge default probabilities by looking at credit spreads as well. Yes. Okay. So a credit default swap basically protects you against default. The seller of the swap issues you default protection. Yes. So the buyer of the swap is taking protection, and in the event of default, he gets his full principal amount back from the person who sold you protection. So this was what was done by some people during the subprime crisis. Yes, but what happened was the company that issued these default swaps, one company was AIG, they almost went bankrupt. So think about it. This is like LIC going bankrupt. They've issued all the life insurance policies. You all think you are set for life. In the event default happens or somebody death happens, you're going to get paid. But what if LIC itself defaults, right? So this was what happened in the subprime crisis in 2008. People thought they were protected against default when they had bought these credit default swap, but the insurance companies themselves were on the verge of default. Yes. So the premium paid is the credit default spread. You pay the premium, you take protection, and you expect to be compensated in the event of it. So this is how it works. Yeah. So in case default happens, sellers pays the buyer of protection default, and the buyer is technically protected. Okay, now please understand, default can not only happen to individual companies, it can also happen to countries. So recently you could have looked at default probabilities from credit default swaps. So have a look at this. So this is India data, but interestingly, let's see. If you go to sovereign credit default swaps, you would have seen this, right, in your fixed income class?
Yes.
Yeah. So by looking at these credit default swaps, you can assess the probability of default. So if you look at the countries at the top, the default probabilities are very low, whereas countries in the bottom, Russia has already defaulted, Turkey probability of default is high. So India is not here. Anybody tell me why? So India doesn't have a very active credit default swap market. That's the problem. But if I were to guess where we would be slightly ahead of Poland, I think. Around about 2% default probability. We should be ahead of Indonesia, maybe slightly near that, but definitely not ahead of China. So our default probability is probably around about 2% right now. So you can see, so by looking at these credit default swaps, we can tell what our default probabilities is. And that is very important because borrowing costs are a direct function of default probabilities. So if some problems happen and default probabilities rise, then our borrowing costs will go up. So hence, you must understand about default probabilities. Okay. So payments usually made, so other things to note, payments are usually structured quarterly. Yes. So in the event of default, settlement is made. Yes. So usually settlement will be made in cash because because nobody wants to be stuck with bonds of a defaulted company. And that's how it goes. So why is this market very attractive? Yes. The market is very attractive because you can transfer default risk from your portfolio to somebody else. Yes. You can hedge yourself against default risk. Yes. So hedging your portfolio in the event of default is a very good thing if you can default. If you know a default event is coming, right? Okay, so this is a valuation example of how default probabilities work. We will not do any of this because it's a bit complex. But the point is this. That you must be able to protect your portfolio against default in the event an event gets triggered. Yes, and you must understand default probabilities increase more in a recessionary environment rather than in a growth environment. That is very obvious. The credit cycle reverses and heads lower. When the credit cycle turns and default probabilities rise, like right now, this is a period where actually I think the next 2 years default probabilities are going to rise like anything. So hedging your portfolio is very, very useful in such a case. Okay, students. So now I will show you, play you two interesting videos. One on what a credit default swap is, and two, what happened in the 2008 crisis that triggered, was a very big trigger for defaults. Yes, so we'll look at both of these videos.
Hello, David Harper of Bionic Turtle in a brief tutorial on the credit default swap. The credit default swap is the most commonly traded credit derivative. To illustrate, I have three elements on the page: a reference asset, the investor who buys protection, and the default swap seller who sells protection. Start with the reference asset in purple. This could be either an entity, by which I mean an entire corporation or even a sovereign, or it could just be a specific obligation, a loan or a debt instrument. Think of this as a bond. Notice I did not draw a line between the reference asset and the investor or protection buyer. That's because the investor may own this underlying bond, but the investor does not need to own it. So this is an important feature of the credit default swap. An investor can buy protection on an underlying reference asset without actually owning it. If we look at the investor now, the protection buyer, what we have is a bilateral contract between these two counterparties. Here's a counterparty, and the default swap seller is also a counterparty. You've heard of counterparty risk. Technically, both the buyer and the seller incur some counterparty risk in the credit default swap, although the investor has greater counterparty risk. This is a contractual agreement, a bilateral contract between the buyer and the seller, such that the buyer is going long, taking a long position in the default swap, or more commonly we say this investor is shorting the reference asset because they are really transferring the credit risk over to the seller. So part of that agreement, it's really like an insurance agreement. The investor is paying, typically on a quarterly basis, premiums to the default swap seller. That premium was called the CDS spread. It's typically basis points multiplied by the nominal. So there's a guaranteed premium payment on a regular basis for the tenor or duration of the contract from the investor to the swap seller. If there is no triggering credit event, that may be all that happens. This investor has simply paid premiums to the swap seller. Nothing bad happened to the reference asset, and that's the end of the story. On the other hand, the investor is paying these premiums on a contingent event, such that if there is a credit event according to the terms of the contract, then the seller is obligated to compensate the buyer for that. This seller has essentially purchased the credit risk on the reference asset. And so here I've illustrated the cash settlement. There can be either a cash or physical settlement. So if there is a credit event, in this case, the default swap seller, because he or she's been collecting premiums along the way, must pay 1 minus the recovery rate to the protection buyer. That's the cash settlement. More common is the physical settlement, in which case, again, this is a contingent event. There has to be a credit event. Then the CDS buyer must deliver physically the reference asset to the swap seller, and the swap seller then has to pay in cash 100% of the face value. So you can see the protection buyer, as long as the seller makes good on their part of the arrangement, the protection buyer has been completely protected from the credit risk of the underlying reference asset. So we may ask, well, what constitutes a credit event or triggers the payoff of the seller from the seller to the buyer? Well, that depends on the contract between the two counterparties. However, the International Swaps and Derivatives Association has standardized certain terms that constitute the triggers. And so we have bankruptcy, obligation acceleration, obligation default, failure to pay, repudiation, and the most controversial element, restructuring. Controversial because it's very hard to objectively define what constitutes a restructuring. And so one point I'll make about these ISDA standardized triggers are that a normal credit agency downgrade, say from BBB to BB+, typically does not constitute a default event. Certainly, a downgrade below some threshold may constitute a credit event or trigger, but typically a single notch downgrade would not constitute a credit event under a standardized ISDA contract. So that's an introduction to credit default swaps. This is David Harper of the Bionic Turtle. Thanks for your time.
So that's what a credit default swap is. Now, so as I told you, AIG was a company that issued a lot of credit default swap. And when actually default started happening, AIG didn't have the money to pay, right? So they were just writing the swap, collecting the premium and enjoying it. And ultimately, when a default event happened, they couldn't pay and they almost went bankrupt and the entire financial system could have collapsed. So let's see. Look at that video. That's
Scalar is organizing this free workshop on introduction to Tableau. And if you are an aspiring data analyst, business analyst, or anyone who
11 years ago, the world saw the most serious economic collapse since the Great Depression. The waves of this collapse went around the world, touching every continent and every country. Then, when all was said and done, the finger-pointing began to see who was to blame and who should pay the price for this crash. In this video, we'll see how the insurance company AIG largely avoided taking the blame despite ultimately being the single largest cause of the Great Recession. This video is brought to you by Audible. Get a 30-day free trial by registering with the link in the description. To understand AIG's role, we first have to grasp what happened in 2008 and the events that led up to the crash. During the late 1990s, America was getting a huge flow of foreign funds from Russia and many Asian countries which were beset by financial crisis at the time. American banks naturally did not want that money just lying around earning no interest, so they made it easier to get mortgages as a way to lend out this cash. Americans who would normally not get home loans found it very easy to get the mortgages they needed to buy houses. After all, this was the American dream. Banks made it easier and easier to get a loan, creating adjustable rate mortgages with low early payments and accepting people with low credit scores. These less than ideal loans were called subprime mortgages. Now, what banks usually do as a way to make more money is to bundle thousands of mortgages together as a single bond, known as a CDO, and then to sell these bonds to other parties, like pension funds, insurance companies, or other banks. However, since subprime mortgages were riskier, many of the funds that would normally buy these CDOs could not afford the risk to buy them, unless the banks employed a little bit of financial trickery. You see, if you bought an insurance policy protecting you from the CDO failing, then you could buy it much more freely, and this is where AIG comes in. AIG was at the time the largest insurance company in America, with branches and offices in over 80 different countries. They've been in business since 1919 and have been declared America's largest underwriter for insurance across many industries. In 2008, they had hundreds of billions of dollars in assets and were in fact well on their way to becoming the first company in the world to achieve $1 trillion market cap. Here's what this huge company did to transform very risky CDOs into much safer products. In a little office in London, AIG was performing financial alchemy. They were selling insurance on CDOs that had a very poor credit rating, effectively swapping it with the rating of AIG itself, a very solid and highly rated company. This insurance policy was known as a credit default swap, and it literally swapped the bad credit rating of the CDO with the great credit rating of the big insurance company. You were still buying these horribly rated CDO bonds from the banks, but since AIG was willing to pay you off if the bond failed, well then what was the risk? AIG loved the credit default swap and so did the fund companies. In the 5 short years after introducing it, that little office in London, known as the Financial Products Division, saw its revenues quadruple to over $3 billion per year. Every time AIG sold another credit default swap, they were making free money in the premiums being paid to them. It was almost too easy. But AIG got greedy. Normally, if an insurance company insures you for $1 million, they should have $1 million in assets around to pay it, just in case. Instead of having the capital, however, AIG were relying on the statistical probability that the housing market would not fall. This strategy worked until it didn't, and in 2007, the housing market crashed. All those subprime mortgages increased their adjustable rates, and thus millions of Americans that should never have had mortgages saw their monthly repayments increase. When those mortgages weren't getting paid, the bonds filled with these mortgages, the CDOs, also started collapsing. But the banks and funds weren't concerned yet, and rightfully so, because they had an insurance policy, these credit default swaps. The banks were relying on AIG to honor their end of the bargain. But when the time came, AIG realized it had insured far too many CDOs to possibly pay up. As soon as AIG's coffers ran dry, all the banks it had insured also started going down. The speed of the collapse was incredible. AIG ran out of money on September 15, 2008, and later that same day, one of America's oldest and largest banks, Lehman Brothers, was forced into bankruptcy. That day served as a wake-up call for the government. Up until then, the Federal Reserve was taking a hardline stance against government buyouts, hoping to teach Wall Street a lesson. AIG, however, was no small insurance agency, and the Fed realized that if AIG failed, the entire world was in trouble. Virtually all banks and insurance companies had stock and policies held with AIG. Everything was too connected. Thus, AIG was deemed too big to fail. And on September 16, 2008, just one day after the US Treasury said there would be no more government bailouts, the government bailed them out. In return for a massive cash loan to pay out these credit default swaps, the Federal Reserve took an 80% equity stake in AIG, allowing the government to change the leadership of the company, which they did. They installed a new CEO, hired at a salary of just $1, who would be in charge of undoing the complex financial maze AIG had created. AIG then used $165 million of bailout money to pay executive bonuses, not for good performance, but for incentives to help undo years of bad financial practice. In total, AIG received a bailout of $182 billion, and in March 2009, they reported the single greatest loss in corporate history. As a result of that announcement, the Dow closed at the lowest level it had been since 1997, and at just 50% of its recorded high in October 2007. AIG also settled a lawsuit brought against them, paying the largest class action settlement of nearly $1 billion to investors who were clearly misled. As a result, AIG reduced its staff to less than half its 2008 numbers just to remain profitable. Interestingly enough, once the dust had settled and AIG's business had stabilized, the government's stake in the business actually became a profitable trade. In 2012, the Federal Reserve sold their shares of AIG to make a $22 billion profit, a truly unprecedented result considering the size of the bailout. It took another 5 years before the government considered AIG safe enough to remove it from the too big to fail list, and ever since, it's been back to the good old boring days of insurance. AIG never caught the same backlash as banks like Lehman Brothers, who were arguably victims in all of this, since they relied on fraudulent insurance. Thus, it is worth remembering just how close AIG got to crashing the entire global economy. And if you want to read more about the inside story of AIG's collapse from the people in the meeting rooms, you should listen to Fatal Risk on Audible. Using the personal note.
Okay, students, so you can see when you issue insurance, you better have underlying collateral, right? So AIG did not have underlying collateral. So as a result, it almost collapsed the entire financial system. If the government hadn't bailed them out, the entire financial system would have collapsed. Interesting, yes? Any questions, students? Yes, no?
No, sir.
Okay. Okay, before I get to forward rate agreements, which is also an interest rate management tool, there is one more swap. Now, remember, we've heard about swaps, basically, which look at exchange of fixed income to floating income cash flows. We've also looked at currency cash flow exchanges. But what can you do a swap which actually exchange cash flows from risk to non-risk? Say you want to invest in the stock market and take risk related to it. I want to just be in fixed income and not take any risk. So, so if somebody can, so can people like that do swaps? You and I can't do, but institutions who have that view. Let's say institutions in the next few months, one set of institutions one institution believes that market is not worth taking risk. Another says, oh, market's going to go up, I'm going to take risk. So in the even that views are there, differing views are there. Can we do a swap? Yes, you can. And that's called the total return swap. And we'll have a quick look at that before I go to the next topic.
Today we are going to see that how total return swap transactions work, which are the reference asset involved within those total return swap transactions, various legs, and definitely benefits and the risk comes out from those total return swap transaction. So what is total return swap? A total return swap is a bilateral financial transaction between a counterparties to transfer or to swap the benefits of this reference asset in exchange for a continuous cash flow, are typically a floating rate, such as LIBOR plus or minus some basis point. So now in our example, we are going to see that how total return swap exactly works into a financial market. So we are going to have a two-party, a bank A and X as a hedge fund company. So it's a bank A. We will call bank A as total return swap pair because this is the ultimate owner of this reference asset. And the other party we are going to call as X hedge fund company. X hedge funds company. We will call this company as a total return swap receiver. So now we are going to see in this example that how total return swap transactions work. X, which is a hedge fund company, approaches bank A. Can you please synthetically transfer this 1 million worth of reference asset to me and transfer all those capitals and investments benefit, all capital and investments benefits to me, and I'm going to pay you back the floating rate, which is nothing but a LIBOR plus basis point. LIBOR plus basis point, and any capital depreciation if happens to this particular reference asset. The bank A had given a thought. He told, okay fine, this looks a very good contract to me, but based on your credit rating, I'm going to charge you LIBOR plus 300 basis point. Point to be remembered. Lower the credit rating, higher would be the basis point. So both of them agreed on this terms and condition, and they came into a contract. So on a good day, bank A, which is total return swap pair, will synthetically transfer or will synthetically sold this particular $1 million worth reference asset to this X as a hedge fund company and transfer all capital and investments benefit to him and will get returned back a LIBOR plus 300 basis point. If anything goes wrong with this particular reference asset and it's got depreciated into a real market, then this X, which is a hedge fund company, taking a guarantee that he is going to pay back a capital depreciation whatever happened to this particular reference. So now in this case, this party is become a guarantee seller, and this party becomes a guarantee buyer. So that's how. So as this party is giving a guarantee that if anything happens wrong to this particular reference asset, he is going to pay back the capital depreciation. So this party become a guarantee seller, and this party become a guarantee buyer because is buying a guarantee that if anything happens to this particular reference asset, I need that differences back. So now we have seen that how total return swaps work. So now we will see about the various legs. So this is leg 1 for this swap transaction, which is include a cash flow and a capital flow, or you can say a cash flow and a capital appreciation. So a leg 1 will be a cash flow and capital appreciation, and this will become a leg 2. This will become a leg 2, which is include the coupon, and this will become a leg 2, which is include your coupons, which is floating rates, and any capital depreciation. This leg is called as total return legs, and this leg is become a funding leg. So these are the two legs involved in this swap transaction. So this leg is called as cash flow and a capital appreciation and become a total return leg because it's transferring all those capital and investments benefits to this party, so that's why it's become a total return leg. And this party is giving back a coupon and a capital depreciation, which is a guarantee, is become coupon and a capital depreciation, which is nothing but this party is funding this party by paying this and this. That's why it's become a pending leg. This is become a funding leg. Sorry. So now we have seen about our various legs. So we will see. Now we will see reference asset. The reference asset within the total return swap, it could be a single equity, it could be indexes, it could be an oil-backed, credit obligation, it could be a convertible bonds, it could be a credit card asset, it could be a credit card asset-backed security, it could be a lease as a reference asset, it could residence mortgage-backed security, CDO notes, and it could be etc. So this could be the reference asset for a total return swap transaction. So now we are going to now we have seen about a reference asset. We will discuss about the benefits and risks of this total return swap transaction. So what are the benefits? The benefits from bank A perspective is receiving a LIBOR plus some basis point, which is the guarantee against this reference asset. That could be the first benefit. The second benefit would be he is receiving a capital depreciation if anything goes wrong with this particular reference asset. Third one, it is he's transferring the asset risk to this party. That could be, you can say, the benefits. The risk, it could be an interest rate risk. If this goes down, sometimes possible that the LIBOR could be go down. So this is the interest rate risk for bank A. The major benefit for X, which is a hedge fund company, is by just paying a LIBOR plus this 300 basis point, he is getting an exposure for worth of $1 million. So this is a major benefit from this perspective. The risk from this X hedge fund company, if the interest rate increased, he had to pay a much more interest rate. So that you can say a risk. Second, he is owning a capital risk of this particular reference asset. If anything goes wrong, the capital depreciation he had to pay from his pocket. So again, that's a risk. So we completed the benefits and the risk, some of the benefits and the risk part from total return swap transaction. I think this video will help you to understand what is total return swap.
Students, my question to you is this: when will you do a total return swap? You are there, students?
Yes.
Yeah, so when will you do a total return swap? So that's the more important question. Okay, so when the economy is doing well, when interest rates are coming down, yes, and when stocks are going to do very well or risky assets are going very well, yes, then you can do a total return swap. Remember, you want to get the benefit of prices moving up. However, if the economy is going down, interest rates are going down, interest rates are rising, like right now inflation, and stocks are going down, you don't want to do this because you are responsible for the losses. You will do well if your returns, remember, you are borrowing, you are basically paying a floating rate. Yes, when will that be reduced? Whatever you are paying, when will it be reduced? When interest rates are coming down. Yes, and you want to, in exchange, you get the benefits of rising risky assets. It can be stocks, bonds, commodities, anything. So you're trying to get the benefit of risky assets going up. So when an interest rate rising environment with risky assets going down, you should not buy a total return swap. You could actually sell a total return swap in a rising rate environment when risky assets are going down. So that's, but the benefit is if the market is going up and interest rates are going down, which happened from 2008 to 2020. Yes, total return swaps made you a lot of money. Is that concept clear, students?
Yes.
Yeah. Okay. Any questions on anything discussed in this class today regard to swaps, etc.? Please do remember to turn in your assignments. I don't think there's much time left. Maybe we have, like you said, 9 days left. Ensure that you turn in your assignments, students.
Sir, could you explain in detail like the assignment?
So the assignment is to place virtual trades on tradingview.com. I had showed you how to set up the account and all, right?
Yes, sir.
Yeah, so you have to place 20 trades, meaning 10 trades buys and 10 trades sells. And if you have not done anything now, I'm not going to give you much marks because you will do all trades together. So that carries lesser marks than people who have been doing throughout. So please ensure that you systematically, you have to give the reasoning behind why you place the trade, technical, fundamental reasons, etc. For each trade, you should give a reason and submit a report. That is assignment number 1. You should also present on that. 1 or 2 trades on that. 5 marks is given for presentation and 25 marks is given for the simulation. Then the second assignment, the second assignment is also something that I've been showing you in class, where you go on obstraedge.com. Each one of you have been assigned a company, right? You know that, right?
No, sir, I haven't been assigned any company.
We assigned everyone. Hey, Mahesh.
Sir.
Can you share the company assigned to him?
Yeah, actually, Nidhi had placed it in our WhatsApp group. Sir.
Oh yeah, it's already, it was sent to your WhatsApp group.
Okay, I'll see there.
So on that company, you have to come up with 5 to 10 option strategies which are profitable using the Obstra Edge Define Edge platform. You can just ask Mahesh. He will brief you on it.
Okay. Sir, the trading view you were talking about, we can't have derivative trading on that.
No derivative trading on that, just stocks.
Just stocks. Okay.
Yeah. Only you can buy and sell stocks. Yeah.
Okay. So far, I don't have any trades, so I will put trades from Monday.
Yes.
But I have tried a little bit on IQ options. You recommended that as well.
Yes, you can do either one. I don't mind.
I have a few trades and profitable ones, but in IQ options, I didn't found any Indian stocks. So
Yeah.
most of my trades were in the dollar to the Indian market.
That's okay. That's fine. No issues.
Okay, that
you can include those also.
Yeah, okay, sir.
So you can present on one of those now?
I will need some time. I have the trade, but I will need some time to gather up the ideas.
Okay, so you go present in the next class then.
Yes, sir.
So please inform the students that only next class they can present, otherwise they will lose the 5 marks.
Yes, sir.
Yes, 5 marks will be given for presentation. So in case you have doubt about the assignment, go into that Google Classroom. You're already part of this, right?
Yes, sir.
Yeah. So click on assignment 2 for the second assignment. And look at the instructions. You don't have to stick to this strategy. The difference in this assignment, this was my assignment assigned to my MBA students. But the difference is for your stock, you have to do all the strategies and not necessarily these strategies, but according to Obstra Edge, find the most profitable strategies. In Obstra Edge, there's a probability of success and risk reward ratio. Those you have to bring into the picture.
Okay, sir.
Anyway, Mahesh can brief you further because he has completed the assignment. So for your particular assigned company, you have to do those strategies.
Okay, sir, I'll do that.
Okay, any other questions you guys have regarding how the class has gone or anything else? Any clarification? Mahesh, anything?
No, sir.
Anything different we need to do in the class? Any particular areas of focus? we need to focus on? Yes.
No, sir, it's fine.
Okay, so in that case, I'll leave you early because I'll take the new topic in the next class. I'm very close to finishing most of the topics, so I will see you guys in the next class next week.
Yes, sir. Thank you, sir.
All right, all right, all right.
Thank you.
Please inform the students to complete all their assignments by then. Thank you.
Yes, sir. Thank you.